Good morning. Retail pad development in master plan communities, corporate credit tenants, and the ground up construction or GUC lending, as well as the stabilized multi tenant financing. So, my name is Bill Rapp. I work with the EXP Commercial's Viking Enterprise team, and we service Katy Fulshear in West Houston, but also the surrounding growth corridors in Houston. And today I'd like to talk about retail pad development inside of master plan communities or MPCs. And why is it's one of the most durable commercial real estate strategies in Texas growth corridors. And when paired with corporate credit tenants and structured correctly with ground up construction financing, these projects can transition from development risk to long term stabilized cash flow assets. So, in markets like Katy and Fulshear, where rooftops and income levels and traffic counts continue expanding, retail pads positioned at hard corners and major entrances offer predictable tenant demand and strong exit options for their investors. And the strategy is pretty simple. There's much more to it than that, but you start with securing the dirt in a high growth master plan community. Then you pre lease it to corporate credit tenants and execute GUC financing with disciplined leverage. And then refinance into stabilized long term debt or portfolio multi tenant financing. Done correctly, this is a wealth compounding model. Let's look at why master plan communities matter in the equation. And master plan communities create built-in demand. And how they do that is that they provide controlled, consistent traffic flow in school districts that drive residential growth. But the HOAs regulate the aesthetics and keep it a place that people want to live. And there's long-term population density. And in West Houston corridors like Katy and Fulshear, retail development is demand-driven and not speculative. In pads near grocery anchors or medical corridors and high-visibility intersections lease faster and hold value longer. Remember, retail follows rooftops, and rooftops are expanding in Texas. Let's look at the role of corporate credit tenants in the process. And corporate tenants dramatically reduce the risk. So think of national brands, so quick service restaurants, McDonald's, Chick-fil-A, Whataburger, or national coffee concepts like Starbucks, BlackRock, or corporate medical operators, or even branded convenience and service providers. And when leases are structured with corporate credit tenants that have 10 to 15-year primary terms and their corporate guarantees that go along with it, that produces strong rent coverage. And typically you're going to see built-in escalations for expenses. And lenders treat these as lower risk assets is the way to look at it. And that tenant credit strength directly is going to impact for you as the investor your loan proceeds, but it'll also tend to compress your cap rate so values get higher, which you can exit at a higher price. And you presented a better debt yield, and that really is where development turns into institutional grade real estate. So, ground up construction or GUC lending for retail pads. And GUC lending for retail pads is typically structured with the 60 to 75 loan to cost offering. And you'll see interest only during construction, and generally your construction is a 12 to 24 month term. And interest reserves are built into the loan for the interest payments. And you can refinance upon certificate of occupancy and your lease stabilization into long-term financing. So some key underwriting drivers will include your tenant pre-lease commitments, your developer liquidity, but also your construction budget accuracy from the outset. And that helps you get clear on your exit strategy. And lenders who focus on debt yield and stabilized DSCR will not only just look at that, but also loan to value. So a signed lease with a corporate guarantee can materially improve your leverage and pricing is the thought. So when we transition to stabilized financing, once the property has been completely leased and stabilized, your financing strategy will shift. So your options are going to include a single tenant stabilized loan, if that's the way you're parceling it, but it'll tend to produce a lower cap rate environment, so values increase. And you'll be able to get longer term fixed, say from 5 to 10 year fixed rate, potentially at 70 to 75% loan to value. But also non recourse options are on the table. For multi-tenant strip center financing, underwriting is really blended to DSCR. They'll also look at lease rollover schedules, and the credit diversification of your tenants matter. And there's always a focus on weighted average lease term, or WALT. And stabilized retail and master plan communities often attracts, say, regional banks or CMBS lenders and life insurance companies, as well as debt funds as options. And that's where long-term wealth is built. So let's look at some risk factors to manage. Even strong retail pad developments require discipline. Try not to overpay for the land and try not to underestimate site work involved, but focus on stronger tenant credit and longer lease terms as opposed to shorter. And try not to be overly aggressive in your rent projections. And in Texas, growth markets, underwriting conservatively while planning for refinance flexibility is critical. And the point is that exit design matters more than your entry optimism. So let's look at why this strategy works in Katy and Fulshear. And there's a high per capita income, which has led to rapid residential absorption and school district strength, as well as major traffic corridors like I-10 West, FM 1093, and the Grand Parkway. And retail pads in these corridors are not speculative. They're response-driven development. So for developers, investors, and owner-operators, this strategy bridges development upside with stabilized income durability. So let's talk about why capital advisory matters. So retail pad development requires alignment from a few different angles. And the first being is your land acquisition, but also arranging your construction capital, and then worrying about your tenant structuring, and then your permanent financing. And when brokerage and capital advisory work together, leverage becomes strategic and not reactive. So if you're evaluating retail pad development inside a master plan community, structure the capital stack first is the thought, then build. My name is Bill Rapp. You can visit my website, houstonrealestatebrokerage.com, figure out how to get a hold of me, and I'd love to talk to you more about your scenario. Take care.